Well, very good. So this is, of course, our quarterly webinar to describe the first quarter 2025 economic outlook with a look back emphasis and portfolio review that Gina will cover. I think it is interesting that last quarter we had multiples of clients on the call. Today it's the height of spring and we have very few. I think that's an interesting testimonial that outdoor flowers are more attractive than economic charts. We'll do our best to make this interesting and exciting. All right. So the idea here and the reason we extended the timeline to have the first quarter review all the way in the middle of May is that we wanted to actually see what the first 100 days of the Trump administration look like. And if we'll go to the next slide, we'll look at it through the lens of the stock market. So here's a chart going back a full year of the S&P 500 index. And as a reminder, the S&P 500 is the largest 500 of the largest U.S. corporations. And you can see the first red box, November 5th, is, of course, election day. And notice the moment that the word got out, stock markets responded, this index responded very positively, straight up, because Donald Trump is seen as pro-business, anti-regulation. So it's basically drill, baby, drill was the idea, whether it's in timber, metals and mining, oil and gas. The whole natural resource sector responded very positively to the election of Donald Trump. And as we roll forward, you see that the stock market made an all-time high on February 19th. I kind of refer to that as the champagne cork model. An enthusiastic market rushes in. It's analogous to a champagne cork. But on February 19th, the last bottle was drank and there was no more fuel. And the market suddenly woke up with kind of a reality check hangover. The hangover culminating in Liberation Day on April 2nd, which of course was a shocker because the industry analysts and the consensus out there was that Trump's tariff proposals would represent roughly an average of between 13 and the highest estimate was 18% average tariff for imports into the United States on average. And on Liberation Day, he pulled back the curtain and it was an average tariff increase of 22%. Hence the swan dive in the stock market. Of course, there's nothing to motivate a guy like Donald Trump more than perception. And of course, this picture really, I'm sure, upset him to no end. And the response was a few days later was to say, actually, I didn't really mean it. We're going to put a 90-day pause on this, and we're going to have 180 countries call in to the White House to schedule meetings to go through our negotiations. Well, many regard that as a kind of in the game of poker, you're revealing your hand. At that moment going forward, the market believed that, okay, Donald Trump bark is worse than his bite. And of course, on April 21st, there was additional press releases from the White House that indicated hope for tariff relief. And of course, the negotiation last weekend between Scott Bessent, who's the head of the Treasury, and the Chinese trade negotiator, in which they came away going from what was 145% tariff for Chinese imported goods, which, by the way, just imagine this. You are a Chinese manufacturer selling stuff into the United States. 145% tariff effectively is a trade blockade. Chances are you're not going to be able to sell anything with that kind of markup to your product. So it really was forcing the hand of the Chinese and the United States, both, because we cannot live without a vast mix of Chinese imports. So now, instead of 145%, I'm sure you've all heard the headline, now it's just a 30% tariff. But take note, the tariffs in place prior to Donald Trump's election were 10% across the board from China. Now they are being proposed at 30%. That's a tripling you can imagine the ripple effect into the Chinese manufacturing sector and for the importers here in the United States, how to manage a 30% increase on your imported goods. Okay, so here we are. The key number, as you've heard me say before, to watch as an investor is the 10-year government bond interest rate. And the reason for that is very simply that since the Federal Reserve Act was enacted in 1914, the United States has been embarking and is on a debt-based growth model. So growth in debt, expansion in debt is key to our economic miracle here in the United States. And we have created a vast, deep swimming pool of capital and expertise to manage that debt. But what you saw post-COVID was an increase in debt that is totally unprecedented. And of course, it was, in our view, an appropriate response to a global pandemic, which had the risk of driving the entire globe into a massive depression. So governments worldwide responded by borrowing huge amounts of money to prop up their economies. One thing was unique about the COVID response in terms of worldwide debt is that the United States market was the only market big enough to absorb that much borrowing. So virtually every country that borrowed to mitigate their depression risk borrowed in US dollar denominated bonds tied to the 10-year government interest rate. So that's why this number is so critically important. And the benchmark out there is that interest rates at 4.5% are about the highest they can possibly be to manage this degree of global debt. And you'll notice that the rate here, if you can see that little box off to the right in green, is 4.45%. This chart came out Monday. We've been flirting above 4.5, below 4.5. This one is a really important thing. It ties back to your mortgages, your car loans, your credit cards, your business loans, etc. So you'll notice that this has broken the downtrend that was in place all the way up to early April, because the market, as of early April, had actually been believing that the DOGE effort was going to produce up to $2 trillion of federal spending cuts. Well, I heard on the radio just the other day that they have positively identified $165 billion of cutbacks in government expenses, but we're nowhere remotely close to achieving a $2 trillion cut. And now that the Trump administration has put forth its budget is a budget buster. It increases debt considerably over this next 10 years. So the market is saying to the Trump administration, you got more work to do. You've got to get us back into balance with respect to deficits and debt. So what does this mean for a globe that is entirely dependent on the U.S. dollar? It's really, really critical. The U.S. dollar is the global reserve currency. At the end of every day, all the goods and services that transact worldwide, roughly 83% of them settle in U.S. dollars. So a vast amount of money in bank reserves, companies, coffers, et cetera, are being held in U.S. dollars. Well, you can see that at the outset of 2025, when the dollar hit the peak in the post-Trump election, that as the tariff policies started taking shape, well, this rattled the cage of status quo big time in relation to the confidence in the U.S. dollar. That is about an 8% decline in the U.S. dollar in the first quarter of this year, which is similar to like a maybe 9 on the Richter scale when it comes to an earthquake. That's a big, big deal. And it's causing a big rotation in investment policy whereby foreign central banks and companies and countries start pulling back from the U.S. dollar and looking for alternative ways to store their surplus cash. Remember, most of these countries, whether it's Korea or China, they are net positive exporters. They sell more stuff to the United States than they buy from everybody else. So they build up cash every month Japan also. And they store it typically in US dollars. Given Trump, and you can imagine how foreign government leaders and trade representatives feel about Trump. I think they kind of think he's, in the doghouse big time. Well, the ripple effect is that they pull their money back from flooding it into the United States. That has big ramifications for our investment policy. Next slide, Pete, please. And of course, a decline in the US dollar, one of the best alternatives globally is gold. And so gold, of course, has been marching higher, eclipsing $3,000 an ounce. It has, in the last week, started exhibiting signs of exhaustion, but that does not mean there's a big bear market ahead. It simply means that gold needs to consolidate its recent gains. The new kid on the block when it comes to, alternative asset classes, of course, is Bitcoin. As an alternative, it has not been proven, but nevertheless, Wall Street has jumped in with both feet. And the emerging portfolio of alternative assets, which of course includes US dollar denominated money markets, euros, yen, et cetera, now includes a slice of Bitcoin. And it'll be fascinating in the coming year or 2 or 3 or 4, the rest of our lives, frankly, to see whether cryptos can actually play the role of currency, which is number one, a store of value, and of course, which is liquid. So Bitcoin does check those 2 boxes right now, but it has not been proven yet. So caution be advised. Here's a really important snapshot of U.S. manufacturing as described by the Institute for Supply Management, the ISM Manufacturing Production Index. An index above 50 indicates a strong and expanding manufacturing base. You can see from the last print that we're down at 45%, having broken below 50 and the prior low. Well, as much as Donald Trump would like to tell you that this tariff policy is going to immediately cause a jump up in manufacturing, the manufacturing index is telling us otherwise. And the reason for that simply is, even if you are a Chinese manufacturer and that 30% tariff holds, and you do the accounting and decide you cannot afford to sell your product at a 30% tariff, one option you have will be to move your factory into the United States where you pay no tariff. But that decision-making cycle is going to take at minimum a year if you're a speedboat, and most likely 3 to 5 years. In the short run, what it means is that we're going to have fewer products coming into this country and a scramble to try to replace those products in new supply chains. I've often felt this is one emerging idea that has not yet made anybody any money, but one sector we want to watch closely is the 3D printing, because if you're an importer of a product that cannot be made in China anymore, cost effectively, you may find some of your supply chain is replaceable with 3D printed items. That's something for us to watch. Where this all is taking us in the short run is the word stagflation was on everybody's mind, blazoned across every financial publication between, say, 1976 and 1982, when we suffered the worst stagflation in American history in the aftermath of the OPEC oil embargo. The big question mark here, and it's by no means a guarantee, but I think it's for Gina and I, it is, if we're going to err in any direction, we're going to err in favor of the probability leading to a stagflation in the coming year, which simply means inflation goes up as the tariffs kick into gear. In fact, if any of you saw the online headlines this morning, Walmart came out with an aggressive press release saying, we have no choice but to start raising prices. Well, Donald Trump is doing conniption fits over that. He's probably on the phone with the CEO right now demanding that they rescind that, but he cannot repeal the economic laws of nature. You constrict the supply and make it more expensive, prices are going to go up. And you have to learn that basic economic 101 lesson the hard way, I'm afraid. So likely we'll see inflation go up here in the coming 9 to 18 months, and that will likely lead to an increase in unemployment. And that in turn is likely to drive a reduction in economic growth. And a little point about gross domestic product, or GDP. GDP in the first quarter of this year was a negative 0.3%. It was widely expected to be negative. The definition of a recession is two back-to-back quarters with negative GDP. So the big question will be in the United States, is this second quarter, which ends, at the end of June, going to be a negative economic growth number? Given what we just went through in April, and given the effect given the rising uncertainty amongst importers and manufacturers and everybody in the economy, I can only guess that uncertainty will lead to a contraction in spending, a contraction in investment. And again, if Gina and I are going to apologize for anything, it's that we will apologize for being too defensive. But I think you have to figure that it's going to be a stagflationary biased economy in the coming 9 to 12 months. All right. So that's where I'm going to hand it off to Gina, where she can talk about our portfolios.
So the big question is, what does it mean to us looking at our portfolios and how we're going to manage this going forward? One of the things that we're looking at, our portfolios are holding up fairly well. We moved quickly after Trump got elected and did a big rebalancing. We also did a big rebalancing after he was in for a few weeks to just see what direction he was signaling he was going. And so we moderated risk tolerance and everything right away. And so we're going to talk about that in more detail. So this is not the model that we are using, but this represents a very good depiction of how we think about stagflation inside of a portfolio. So when you're talking about anything inflation related, real assets, things that you can't easily produce more of, are the things that go up in value more quickly. And so we've increased the gold and silver in portfolios. We're looking at real estate positions. We've been looking at other types of commodities, maybe some sustainable timber and things like that, farmland. And then we've got inflation protected bonds, which is what the TIPS section is. We have used some of those in the past, and we've also used a floating rate bond fund. We're not expecting interest rates themselves to go up right away unless we see big inflation numbers. We think the Fed is going to try and hold here just because of that tipping point in interest rate issue that Stuart was talking about, that 4.5%. The short-term rates that the Fed controls don't directly control the 10-year rates, are really dictated by the overall market, but they do relate back to that short-term rate. And so I think that the Fed is looking at this and going, okay, we've got inflationary push on this side, but the other piece that the Fed looks at is unemployment. And we're looking at the potential for some growing unemployment numbers, especially towards the fall when we get the federal layoffs counted in the unemployment numbers. And so in our portfolios, we don't have private equity, obviously, or private debt, which means those are assets that are not in the public markets. But we are encouraging clients to look at things like holding CDs separate from the stock market, looking at fixed annuities or income annuities as a way to not be directly in the market, in the stock market. But we also need to have a foot in the market, because just as easily as we saw Trump turn the direction on the tariffs, he could turn the direction on a lot of different things. He's very mercurial. And so we don't want to put all of our eggs in the basket of doom and gloom. But we do want to rebalance. And so our strategy going through this period of time is really to do strategic rebalancing quarterly, if at all possible, depending on your individual account and capital gains and things like that. But when you have a time period when different asset classes are acting very differently from each other, you do have the opportunity to say, okay, I'm going to sell some of this that's gone up radically because of some circumstance in the market, like gold and silver right now. I'm going to buy some things that are abnormally down, like pharmaceuticals this past week with Trump's big announcement. Pharmaceuticals got hit hard. And so we're looking at having some of that strategic placement, but also just regularly rebalancing so we can catch some of those moments when things are higher in one area and lower in another. We can take advantage of that over the long term. Our portfolios have been matching the market since we did the big rebalancing about a year and a half ago. We are right in line with what we are hoping to have happen in our portfolios. And so as we're doing this rebalancing work, we still are working with the economists that helped us do the redesign a while back. And one of the interesting things that he pointed out recently is the thinking is that Trump is looking more and more towards midterms, and he is going to moderate his behavior based on the likelihood of winning midterms. I think he's afraid of impeachment, honestly. And that made me hopeful we will have good midterms and we will have the opportunity to vote again. So on a personal level, we want people to kind of tend your own garden. Look at your situation, look at things that you might need to purchase in the next year. Does it make sense to amend that sum? Does it make sense to buy sooner? There is a tendency for this cycle to get started in an inflationary area where people go, oh my gosh, I know I'm going to need to replace my tires next winter. I better buy them now because they're going to be more expensive. And so there's a kind of hoarding thing that can happen that will actually drive prices up more quickly. And so we're not encouraging people to do that. Don't hoard, but actually look at being strategic about purchasing. Obviously, for the environment, it's better to buy used and to repair things and to, look at, do I really need that thing? Can I decide to go a different direction? And it's pretty important to pay down variable rate loans. If we do get into a situation where inflation is so bad, interest rates start to tick up, and there's a concern that they can't get the inflation under control and they're going to have to raise interest rates, then you don't want to be in a variable rate situation at that point. Other kinds of income concerns, because people are going to be facing some unemployment or uncertainty about their income, properties might be harder to sell. And so there's a pretty good spring market still. If you're looking to move, we talked about this earlier in the year, it might be good to look at doing that sooner versus later. Increase your own emergency savings. Look at, like we said, at other types of investments that might be more steady and fixed. Business owners, for slowing economy, look to your business and see, do you need to be more strategic? Do you need to make some of the difficult decisions now so you don't get into a harder place down the road? And as far as a slowing economy, the interesting thing about the economy versus the stock market is, like we saw during COVID, you can have the economy going one direction and the stock market going another direction. And so while we do think we're going to have some big economic waves, the stock market itself might do much better. We've got AI assisting companies in making their employees much more productive. So they might be able to lay off people, but still produce in the same way that they have been and increase their earnings, which is basically what dictates the price of stocks. It really isn't how much economic growth is the company producing. It's really how much earnings, how much profitability is the company producing. And so that's another reason why we're not heading for the hills entirely and we're continuously rebalancing, because we've got the potential for some upside to this, which, we've got a lot of wealthy people pushing for this kind of outcome in the economy. And there's a reason for it. There's a bright spot there. I don't know how many people have found this out, but there's a $2,000 cap on Part D prescription drugs right now for your Medicare. And I think that that's a very good thing. The Trump drug price announcement, while it was a big announcement, it was also it came with not a lot of teeth. So we're going to have to wait and see on that one. The other big thing that we're seeing is restriction of civil rights, potentially the restriction of voting rights. And we want people to be prepared ahead of time, not overreacting, not doom and gloom, but just take some actions ahead of problems so that you're in a better position if things do get more difficult. So, looking at your social media, do you want to archive your social media so you could delete it later if you needed to? Keeping some cash close by or gold, silver coins, things that you could get to if there's a big disruption of the circulation of money, getting your IDs in order, passport, real ID. The difference between the passport and the real ID is the real ID has your address on it. And so you might want to have both of those things in place and really connecting with your community and keeping in touch with your neighbors, building good communities. I'm gardening like a maniac right now and sharing plants with all my neighbors. And that's pretty, I think, a healthy way of responding to the situation. Get ready to record things if you see something funky happening. It's one of our best ways of protecting ourselves. And I'm going to stop there and open up for questions. Thank you for your attention.